Perfect. We have now started. Let me just confirm that it's working on YouTube real quick. Okay, perfect. I think we are all solid to start now. Oh. Okay, let's get started. Take a look at what is going on into the markets. Okay, we're about 30 minutes, just under 30 minutes out from the interest rate release. Let's take a look at the 2-year Treasury yield. So it seems like the market is now starting to price in a little bit more uncertainty, but for the most part, the 4.4 area is really where we would expect that the market is pricing in, or the bond market is pricing in those surprise hikes. So as of right now, it seems like the overall sentiment, at least in the bond market, is more just a potential hold, but starting to prepare for a movement on either side. So here's our quick little update on what's happening, at least with the equities, capital rotation, all that type of stuff. So this morning, we already had news about Iran missile strikes on U.S. forces in Jordan. Trump has already threatened retaliation for that. And then Citadel Securities expecting a surprise rate hike. We don't usually use SMAs or anything like that, so we're not going to talk about that. But NASDAQ seems to be down in a correction. Dow Jones seems to be a little bit more, also in a corrective move, but a little bit more stable compared to NASDAQ. And S&P 500 small caps have bear short-term structure. Number one story today, Iran and the Fed, some maximum uncertainty. One thing to understand about the current macro conditions, especially going into the interest rates, is that this is actually the first time in over a decade where there's so much uncertainty around what is the Fed going to do. For the most part, the market already knows, what type of rate decision we're going to end up getting. Right now, we're sitting at about 25 to 30% probability of potentially getting a rate hike. But for the most part, even the bond market is pricing in that we're potentially going to end up seeing a hold. And the focus is going to be more on the FOMC statement itself. Are we getting more of a hawkish statement, language, or more of a dovish? As of right now, since the market has already priced in fully and pre-positioned itself for a potential hold, even if we do get a hold, it is still going to be considered more of a quote-unquote dovish type of a setup, or dovish type of a language. And if we actually end up getting a hike, then we already have the market that's trying to position for that, but that is truly going to be a complete surprise. And then we have the institutional filings. We have large funds buying into Apple, Amazon. Apple's going to be, both of these are going to be reporting tomorrow after market close. And then we have AMD, semis. Despite bearish options, funds are accumulating semis at lower levels at the moment. TLT, which is your bonds, selling NVIDIA. And XLP, XLE, the energies. Let's continue down. What's happening with smart money versus the retail divergence? Retail is buying up. NASDAQ dips at the moment. Institutions are net reducing tech exposure. this. 669, expecting a little bit more relief with first target into 680. So coming back up here, if the Fed does hold, if it hikes, then we're going to push even below the current levels. So if we actually do end up getting a hike, that's going to be the biggest market shock since 2022. All right, that's what we have so far. Now let's go over to our equities, commodities, and currencies. We'll take a look at the monthly time frame here real quick. We have been quite bullish since April 2026 after this massive push up, at least on the monthly time frame. And then come over to the weekly time frame. We've had a massive top wick rejection here already into the previous highs, into 52,900. We have our support here, the bottom wick rejection from this week, into 51,800. Come over to the daily time frame. So we had a massive push up yesterday. We had that huge push going into 52,900, which is that weekly resistance. And then now price pushed back down today after creating a little bit of a top wick, just straight bearish pressure to come back down into the support areas. We are bouncing off of this daily consolidation here, so we have to be very careful. We are about 20 minutes out from the interest rate release. And since London session, it's just been straight bearish pressure. 4-hour candle, no top wick. The previous 4-hour candle, also no top wick. The current one is starting to hold on to some sort of a support here. Tapped right into this exact consolidation. We are not looking for trades unless price can break above this 4-hour consolidation, continue pushing. And even for sells, this is a very strong level on the weekly time frame. If you notice here, there's a ton of consolidation below 51,800 and 51 almost 500 area. A ton of consolidation, and then price, every time it rejects, we've got a nice bullish move up right here. So that is another area that we have to be careful of. Even if we're looking for scalps down here, we need a hard rejection up top, get some bearish candle closures, hold on to a strong resistance. Right now we just got a 15, but we're still a couple of minutes away, about 17 minutes away from the interest rate release. I am expecting massive wick rejections because, again, this is the most uncertain that the market has ever been here. And so even this morning, when price started to push back down, we got some movement at the New York Stock Exchange open. And then after that, just a lot of consolidation. So it seems more like the market prep. I'm not setting alerts here because I want to see how the first 5 to 10 minutes of the interest rate release will close. NASDAQ, let's come over to the monthly. That's a hard sell-off that is currently happening here. And we have already created a bit of a bottom wick more into the previous daily support areas here too. That is 27,300. Drop down to the weekly time frame. So a really hard sell-off that we've had for about 3 weeks in a row here. Drop down to the daily. Again, hard sell-off after respecting this previous support, and then a continuation down. Drop down to the 4-hour time frame, and this is where we're going to create our zone. No trades unless price can break above close to this 28,000 level, and then a continuation back up. Already we have kind of swept down here into 27,300. If you look to the left, take a look at that level very specifically. This is where we're sitting at. So even if we do try to break below, you still have a lot of consolidation right here to the left on the intraday higher time frames. So this is your exact zone where you're not looking for a trade. If price breaks below 27,300, we are going to be breaking the monthly low. We have already cleared below that previous monthly low here from about May. So that's where our zone is sitting at the moment. If it breaks below that, then we have hard sellers pressure to the downside. But we have to wait for those candle closures because even on the daily time frame, we do have those previous support areas down here. So I'm going to map that out because this is what I want to see. What is price basically doing here? When I drop down to the 4-hour time frame, that's your consolidation support. So expect a lot of massive top wicks, bottom wicks, all that type of stuff. Even on the 15-minute, nice bounce coming back into that zone of 27,600, which is right into that 4-hour support. Kind of just holding on to this area. We're going to stay away from small caps today. We have gold with its support on the weekly time frame, 3986.6. Resistance, top wick rejection. I'm still going to map out actually up top here because this is still the weekly consolidation that's happening. Drop down to the daily. And on the daily time frame, we still have these lower high formations, but price is still coiling down here into the support areas. If I look for a buy, I want price to break above this area and then a continuation back up. If I come onto the 4-hour time frame, it lines up perfectly with this entire consolidation that's happening on the weekly time frame and even on the daily time frame here too. Let's drop down to the 1-hour consolidation, a sweep that happened down here, and price is starting to push back up. So no sells unless I can see price reject right into that zone and then hold on to a resistance and pull back down. Then we can look for sells here on the 15-minute or 30-minute. We're not entering right now. We're 15 minutes away from the interest rate release. Or if I'm looking for buys, then above the 4,060 or 4,070 area. Now we have silver. Silver's going to pretty much do the same exact thing that gold is doing. And we're expecting pretty much a bounce off of these areas here too. So you've got silver support, 55.47. Silver resistance. You can do up top here. I'm going to keep it to this one here for now. 61.06. Since I have rejections here to the left. Drop down to the daily consolidation here. So even on the daily time frame, if I lock in my exact zone, just bring that down a little bit more. That's my daily support. So you can already see how tight, this range here would be. And then in terms of resistance, right into that area. So I'm just going to remove this because it's pretty much the support down here. And on the 4-hour time frame, let's tighten that up a bit more. We know that this is going to be the target. So instead of creating a lot more zones here, I'm going to tighten this up to sit right here. So that way we have those buys to come back up into the previous resistance and then a little bit more to go into 61.06. Now I have my 4-hour support. Right here on the 1-hour time frame, we're starting to see a bounce with some wick rejections as well, and price trying to push back up. So same thing here. I'm not looking for sells unless price comes back up, holds onto a resistance, and then we see that flip right back down, and buys are only valid if I can get some candle closures above that 58.8 level. Is there anyone trading currencies here? It seems like for the most part, everyone in the group is at least just trading equities and commodities.
Just equities and commodities, but I do look at pairs for EJ. That's about it.
EJ, we're not trading that until tomorrow, but I can still take a look at that if you want.
Thank you.
Alright, EJ is finally breaking out of that multi-week consolidation. Last week is the first candle closure that we got, but right now it's sitting into another resistance area, 185.9. You map out the top wick rejections as a potential zone. Drop down to the daily time frame. We've had a little bit of consolidation here on the daily time frame. Price is trying to break above. Today's FOMC is not going to have as much of an impact on this pair as tomorrow's Bank of Japan. So if possible, like I said in the weekly outlook and the market update, stay away from the yen crosses if you can. Because as soon as BOJ's interest rates come out, The market's gonna be looking at that to figure out if we're actually gonna get any sort of intervention or from the Ministry of Finance and all that stuff. On the 4-hour time frame, we have price trying to break above. I would wait for at least a candle closure up top here before a continuation back up. And then for sells, you still don't have sells unless price can break outside of this. Stay out of that consolidation here altogether.
Sweet. Thank you.
Yeah, for sure. Let's come over here. All right, we're still holding on to a resistance here on the 15. For Dow, NASDAQ, S&P 500. We're actually not trading small caps. Gold and oil. Let's see if there's anything else happening right now. Yeah, we're pushing right back down on these 2 years. So the market is not pricing in any sort of rate hikes. Volatility is also picking up. NASDAQ is preparing to come back right into that consolidation. We also had a hard sell from the Korean stocks this morning too, which were impacting NASDAQ. The NASDAQ giving market scenario breakdown based on the market's positioning, sentiment, or FOMC decision, and its impact across indices. Highlight which asset will be the most impacted in each scenario. Nothing on GU just yet. This one's gonna be super volatile as well between today and tomorrow. Alright, here are the different scenarios depending on hold or a hike. Alright, if we end up getting a hold, the NASDAQ should have a strong bounce, get a bit of a relief. Let's see how that lines up with the technical side. Seems like we're starting to prepare for that. But based off the 4-hour time frame, we've had a massive wick rejection to the downside. That is a correction of about 243 points already. So if we can get a flip back up. Main thing is being able to break out of that consolidation to look for those buys to the upside and come back up potentially into these previous daily support areas. Yeah, pretty much clean traffic here to the left once you do clear out of this consolidation and get some counter closures. Dow Jones already most resilient, less upside. For the most part, just coming back into this daily consolidation. So we'll probably set up for a zone-to-zone trade going into tomorrow or even next week. So if there's a hold, then the most impacted asset is going to be NASDAQ. Seems like in either, actually, scenario. If we get a hike, we're going to see a free fall, could see a flush to 640, 645 area. Yeah, pretty much into these previous supports. I don't think we're going to get any sort of cut signals right now. Institutions are currently not positioned for a tech rally, just from the options data that we have. All right, we are 3 minutes out from the rates release. We are back into the support zone of this 4-hour consolidation from NASDAQ. US 30s bouncing off of the support, but still right between this 52,000 almost to 51,800. We're not looking at currencies today. Gold is still in this consolidation as well. All right. We'll pull up the live press conference after the rates are released, a little bit closer to the actual press conference. So after the rates are released here in about a minute, we're still going to give it another 5 to 10 minutes to see where we have candle closures and try to see if there's a clear direction. Alright, here are the rates. They have held the rates. Let's see the monetary policy statement. Perfect. Let's wait for some candle closures here. Economic activity is expanding at a solid pace despite elevated uncertainty due to the conflict in the Middle East. Productivity growth and capital investment are strong. Alright, held the rates, neutral language. We should see some relief here now. That's a nice push. I want the candle closure here. Next candle, given the volume, might not have a bottom wick, so the stop loss would probably be somewhere here. But if I can get a strong candle closure, ideally the next candle gives me a bottom wick and then continues pushing. That would be the best setup. NASDAQ is pretty solid to keep pushing as well, but for this I would want candles to actually close out of that 4-hour consolidation. Alright, here we have our analysis from TrendSpider of that statement. No dot plot just yet. We're going to get that at the press conference. So we have a hawkish hold in tone, but a dovish outcome. Dovish outcome because it's still a hold, so the market had already priced that in completely. So whatever he was going to say here, if he held, it would still be considered dovish. Bonds have dropped. Gold is going to get a little bit more relief. Nothing like oil. Small caps, nice gap up. And a massive sell. We have a great buy opportunity setting up here, at least for US 30 and NASDAQ. If I can get some candle closures here, and then a push back up, 200 to 400 point move easy. So right now the 5 minute is starting to pull back down here. So that's not going to be, if it does end up closing into the zone, that's not going to be a buy setup on the next candle, because I would still want to see some bottom wicks, at least on the 15, for a continuation. Tech relief on no hike. It's going to bounce hard. Everything makes sense here. Same exact stuff that we have been practicing in the backtesting sessions.
Yes. So far, it's
We'll pull up the press conference about 10 minutes before it's supposed to start. Let's get a bottom wick and a flip. What we have also seen in the backtesting sessions, we had the same exact macro environment and sentiment setting up back in 2024, was it, that we were backtesting? End of July in 2024. So we had nice strong candle closures above our resistance areas, and then right when the press conference started, the following 15-minute candles gave us bottom wick ejections. And we had a lot of consolidation zones right into the support area on the daily time frame and even on the 4-hour time frame. So if we get something like that, then we have a straight shot up for clean 200 point moves. Now we can take a look at small caps. $29.10. Perfect rejection. I want to see price staying above this previous daily consolidation resistance. Bit of a wide zone, but I'm going to be more conservative with small caps given their volatility. So if I get a push above here, then we have clean buys, and I would be targeting somewhere up top here. So that should still give me almost 300 points. Let's look at silver. Silver will start pushing soon too, if gold is pushing. Alright, we're coming up on 10 minutes after the release. US 30 has pulled back below the zone. And NASDAQ keeps pushing, but it's back into the 4-hour consolidation. So I'm expecting that we're going to get a clear direction when the press conference starts. But this is, when I'm talking about, wick rejections and all that stuff, this is basically what it is. You're going to get a clear direction once the candles start to close out here. We had massive hedging in the market going into today's FOMC, which at least I haven't seen ever since I started trading about 10 years ago. Let's see if we can get a little bit more of a bottom wick, come back, tap into this area, push back up, closer to press conference. The only thing keeping me away from actually taking an entry right now is because I would want price to dip down a little bit more, given how much consolidation we have down here. So once we get that bottom wick, and then a continuation back up, the market's going to have enough liquidity, fuel, whatever, to continue pushing. Because the last couple of hourly candles here, the current one, no bottom wick, so didn't even try going bearish, even though there's a lot of hedging in the market already. Same thing with the previous hourly candle and the one right before that. But we've already gotten a hard bounce off of the weekly support. So let's just get one more bottom wick and then a push back up. Same thing with NASDAQ. And with small caps, we have to come back in to fill in that gap before a full reversal and continuation. Alright, just a couple of seconds left on this 15. Let's get some updates from Transpider. Alright, here's the new 15. The previous 5 did close with a bit of a bottom wick. Let's get another one. At least a rejection right into the same exact levels as the previous one. That way this 15 also has a bottom wick and we can continue pushing. We don't have a bottom wick on NASDAQ here on the 15 either yet. Alright, so silver got a rejection. Let's get a bit of a pullback. Same thing with gold, right down here, and then push back up. I think gold could have the potential, once we get that rejection here, to come back up into the 4100 area. But this is still going to be a little bit weaker compared to the US dollar because of the geopolitical developments. Alright, I had Transpider look at the flow now after the rates. Gold is clearly the winner. We're already seeing that with the massive push. Alright, now we have institutions buying up. Short covering in gold and bonds after FOMC print, likely fueling their immediate spikes. So this is another reason why we're waiting. I'm waiting for that, at least that bottom wick, because we have the sell the news pattern that's starting to form here, just from this analysis here. But from a technical perspective, you still have candles that are coming back and closing below the zone. You still have a lot of consolidation here that the market should be tapping into before continuation back up. Because if it doesn't tap into it, then it's going to get exhausted. when it comes back up into these consolidation areas right up top here, into for US 30 specifically, into 52, almost 300. With NASDAQ, it's going to exhaust out right below 28,000. So I'm looking for another bottom wick and then a continuation back up. So for today, for NASDAQ, you still have Microsoft and Meta who will be reporting after the market close. So if you're going to be trading those, then you have to be careful because of those fundamentals. And I would argue that more than FOMC, those prints are going to create more of an impact on NASDAQ. With US 30, we're still waiting. In 10 minutes, we're going to have the press conference. So I'll pull that up here in just a bit. Small caps, massive top wick. I'm waiting for that gap fill and then reject closer into that 2910 area almost, or even 2920, any of that, and then push back up. With gold, we got a nice close right above the zone. I'm looking for a bottom wick here into the zone, a little bit more potentially, and then a continuation right back up. Bullish on the 5-minute. That should look like another 5-minute bearish kind of closure, support formation, and then a continuation back up. Entry somewhere up top here. Stop loss could be right below the support that is formed down here, and then a continuation. If price is not ready to continue pushing, like I said, gold is still going to be pressurized by the US dollar because of geopolitical tensions. And basically the war starting up again with Trump threatening the retaliation strikes and all of that. It's going to continue pushing back down. So the best moves that I'm setting up for are going to be on the indices instead. Any questions so far before I pull up the press conference?
Nope, no questions for me.
Let's bring this up. We're tapping right into this area here now. Seems like we're getting more sentiment towards September hikes soon. Alright, so now I'm going to set an alert above the zone. Let's see how big this move is. About 110 points. Still going to set an alert below 51,800. No trades in between here. With NASDAQ, it's going to be above the zone. Nothing in between here either. I'm going to wait for... If this is broken here, then we should have already established a resistance, another top wick. Your technical setup should be pretty much solid. That's a big enough range for price to mess around if it wants to, and then find its direction. Small caps has filled in that gap perfectly. Actually, about a 200-point range almost, so I'm going to bring the alert down here a little bit. If I can get support formations and the price pushes back up, get some candle closures, continuation, we can start with our 1% entry here, 1% risk, and then scale in as price breaks above 29.55. And then an alert below this hourly bottom wick. Gold is pulling back perfectly into the zone here too, so I'm going to set an alert right above and then closer to the 4,050 area. If it wants to pull back down, given the US dollar pressure, so by this point I would be looking for resistance and then a continuation. So if it just continues dropping, I'm not looking for that sell. If it drops below, gives me a break and retest, or gives me a clear resistance formation and then a drop, then that's a perfect sell. Nothing with silver, nothing with oil just yet. All right, we are fully in, cautiously risk on. About a minute left. So let's see if we can actually hold on to support. This is a perfect rejection right into that previous area. So I would want this 30 to still close bearish, the next one to give me another bottom wick, and then continue pushing. So this one to close, the 5 minute to close bullish. Next 5 minute come back down, tap right into the support, and then continue pushing. The entry is still going to be up top here, but this would be a perfect support formation and continuation.
Good day. My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission-focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We've begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks, or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that, because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal, and where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech capex has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows four-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on four questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases.
We're getting candle breaks, top wick and bottom wick breaks on both directions. I'm waiting for a clear direction here before jumping it into anything. Same thing with NASDAQ. We got a nice bottom wick rejection here on the new 30.
Price increases arising from shocks.
And same thing with US 30, still just rejecting into these support areas.
And associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Thank you for taking our questions, Mr. Chairman. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying
Wait
to
for the 15 close here.
You appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves what does that mean about our remit. How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, when we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman, and I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so, I'm sorry, it's your question. So, interpreting markets is an imperfect business. We central bankers, like market pros, can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the Treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the Treasury market signals, I wouldn't be able to do it perfectly. But the bond market's saying many of those same things, and that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Final 5-minute candle for this 15 close.
Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents. Could you characterise the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you're right. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence.
Wait for the actual kind of closure. Almost there.
The path to central bank heaven requires delivering on our remit. These days that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting. And I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much. Not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data.
Still wait for this one too.
At the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead. But I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks. but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
A couple of seconds left for this 15 close.
Thanks for taking our questions. So the Fed funds rate is now
Almost
about
there.
75 basis points below the 2-year yield. Suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate, inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean
I'm going
we
to keep
take
a
them
wider
as, by
stop
dictation,
going with
but we're
1% risk,
observing them.
scale in.
So I think it's a
After the new
mischaracterization
hourly.
to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period
1%
ahead,
risk,
we've got
we scale in
important
after
decisions to make
the
about the
hourly
policy
candle
rate.
closure.
Markets
I'm just
in
going
the
based off the
intervening
volume.
period, I think, have quite a bit of decisions to make.
28.
I'll see if I can put it this way. Monetary policy matters not just by what we say,
I want to
or even
be
what we do. Monetary policy matters
I want to be just
how it
below
affects the real economy.
the zone here if price wants to come back and create another bottom wick like the back testing session that we did. But right now I'm going based off of the volume, and
we'll be continuing to watch that
that is going to be a bit of a
see
stretch here. I'm
how
going to bring it
responds
down here a
to
little bit.
events.
That's the ultimate TP.
That
We're going to
can
take
help
partials
inform
along the way,
decision-making
potential
when
scaling
we meet in
opportunities.
December.
The main thing is that we got a strong 15-minute candle closure here after a bottom wick rejection down here. So we just need price to basically continue clearing above this,
Well, I
and
think,
you're solid for
the
another
vote-
scale
the
in
vote was
as
9 to
candles
3.
continue to close.
The broader
We're simply
discussion
taking advantage of the
in
volume
my
here.
ear
That's it.
over the
That's why
course
it's
of the last
1% risk.
days showed a lot of agreement on the hard questions. 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely.
This is
But
going to be
my
my first
judgment
partial at that
is,
1-to-1.
This is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Thank you, Colby Smith of the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a three-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days.
Partial
Is that
taken.
the dominant remedy if inflation continues to be elevated through the forecast period? Interest rates could well be part of that solution, but I wouldn't say it's in isolation. I tried to describe in my remarks today a point that I made to the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we call that the revealed preference. And so it might have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no. We will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do with the inflation target. Making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like we referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. What we're trying to understand is to what extent are these shocks broadening in their effects, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed.
All right, we got a strong 5-minute candle closure. Strong 5-minute candle closure right into the zone. I've already taken partials here. I'm still keeping my stop loss if price wants to create those bottom wicks for a continuation back up. We've had a really big push on the 30, so that's why I'm still looking for a bottom wick for a continuation back up. If price can close above this area, give me a break and retest and continuation, I will look for that scaling opportunity. But this is the ultimate target. But along the way, we are going to continue taking partials here.
I want to drill down maybe a little bit. What specifically, in your mind, would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big hard questions, and I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermediate period, they didn't pause, they reacted to the inflation data in one direction, strong economic growth in the other direction, and nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve Chairman uses the Jackson Hole Summit as sort of a reset of monetary policy. How do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods. But they matter more, what are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, so I'm checking with the task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple weeks, I'm going to be doing a check back in, giving them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Timmeros, Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. rates bring inflation down.
Any questions so far? Everything makes sense, especially about the entry?
If that's not the channel you're relying on,
Yes, makes sense.
So
Cool.
let me go back to first principles, Nick.
Yes, it makes sense.
I don't believe that either part.
So
of
this
our
is not
mandate
your
is generally
this is not your
the
scaling
other part.
opportunity here. We're still waiting for candle closures.
That price
15-minute,
stability, full employment
your
is
hourly
the
candle
core
closure is going to
proposition.
happen in about 5 minutes. So you wait for the
There
candle.
have been policymakers,
Wait for the next one to give you a
over the
bottom wick.
last
This is
several
the area that I'm
generations who
eyeing here
thought
for a
that
bottom
there
wick
was
and then a
certain
continuation
trade-off
back
there.
up.
That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools in making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order, but really what we're doing as we sit here today at this press conference, I think we've got a reasonable sense of
Just
what
managing stop
aggregate
loss.
demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business capex in and around AI, it's making that calculation a little harder to judge, but in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'm going to I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, when do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us. They weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the Treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
Janelle Marte with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yeah, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. By not spoon-feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I found in the intermeeting period what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we were saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions, and if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So I'm not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast, we don't want your dot, we just want your reaction function. Part of me hears what we really want is your forecast. What we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, we're in crisis mode, we were purposely providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with...
Okay, real quick. Here's a new hourly candle. We got a nice bullish push up, and even on the 4 hour, we have now tapped right into that resistance area that you can see. On the 30-minute, we've already made a bottom wick. The key thing here is that even for scale and opportunity, we don't have candle closures up top here just yet, even on the 15. So this is just more of a bottom wick. Keep eyeing that there's a possibility, as he keeps talking, that price might drop a little bit more here for a continuation back up bullish. For NASDAQ now, same thing. You got a nice bullish push, but on the hourly time frame, no bottom wicks until this recent one. So wait for the first 15-minute candle closure after this new hourly candle for a continuation back up, so you don't get stuck in a situation like this and push back up. Also understand that we have Meta and Microsoft reporting after market close today, so that's going to be impacting NASDAQ a lot too. Small caps have now tapped right into that consolidation area up top here, so still you're looking for the breaks and a continuation up. Gold is solid. It's tapped right into that first profit area that we were discussing, and then next is going to be up top here, and silver would follow everything that gold does. Any questions here? Everything makes sense?
That's our number. We're sticking with it. Who knows come after?
Yep, no questions from me.
Awesome. Whoever's in the trade with me, make sure that you are taking partials, because we keep tapping into the same exact area here. Alright, let's just finish out this press conference. Wait, what's going on?
We talk
Conclude our
about
session.
measures of inflation or something else, and we describe those measures as being consistent with our objectives. We might make them such that they're not very good measures or very good objectives. Broadly, if you said to me standing in front of you, I abide fully by the strategy document, we're going to deliver 2% inflation and not a whisper more. But to achieve that, I'm looking at a broader set of inflation data than PCE. So without sort of fully revealing my cards, I'm trying to understand, like my colleagues, what's the underlying generalized change in prices that are happening in the economy. It is not a perfect science. I might have said 42 days ago I've got a task force for that. But we have a data project that's trying to look and see whether we can't separate the noise from the signal. And so if you would hear a message from me, yes, I care about what the PCE prints are. I care about what the contributions are from CPI and everything else. But my lens is broader than that. even though the remit is quite narrow.
Michael McKee from Bloomberg Radio and Television. I'm struggling a little bit with some of what you said today, and maybe you can help clarify this. You've said over and over again that your job is to bring down prices, to get prices stable, to hit your target, and that you will hit your target. The market says you're not there yet because they've raised rates, but all you've talked about today is talking about it. And it's not like members of the committee weren't there before you talking about it. So I guess what the American people might be asking is, what are you waiting for?
Yeah. So, believe it or not, this press conference is not all I've done today. We have spent an inordinate amount of time in the last 2 days, 2 weeks, looking at our monetary policy strategy, evaluating our tools, thinking hard about the sources of data that we have at our disposal and we wish we had. We've also thought hard about the period ahead. What among these questions will be answered with more clarity, certainly not certainty? So the decision we made today, the discussion we had in that room, was the farthest thing from inertia I can imagine. As a point estimate at this very moment, in a choice between two alternatives, you heard the results of it, but I would tell you that this discussion was far more robust, and our thinking about how best to achieve that target is advanced, and over the coming months I expect it to be advanced much more significantly. If you were to if I were to steal a follow-up question, I won't let you won't be giving it up. If I were to steal a follow-up question, well, what's the world think about what you've done? I would again reiterate, what we do isn't just about what we say. It's not just about what we do. We're in the performance business. And so if I look at the Treasury curve, if I look at the dollar, if I look at a lot of things that are internals inside of financial markets, I think what they're broadly saying is that this committee does own it, has the credibility to deliver it, and they believe, like I do, that we will. But I don't want to leave you with a misimpression. We've got no magic wand. This isn't something that we're going to be able to carry out in days or weeks. But we're going to deliver on the responsibility that Congress gave us. And today's meeting and the preparation for today's meeting was an important step towards that destination.
I'd like to follow up on the task forces as well and ask, what vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, how can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than...
I'm going to get out here, and we're just going to set alerts for a second entry, but I think we're pretty solid for today.
To tackle 5 of the most important questions.
Alright, so we are out of this, and now for, again, re-entry with the new hourly, looking for bottom wicks, continuation back up. Same thing with NASDAQ. NASDAQ is going to be a little bit more into the consolidation because of the earnings that are going to happen here in just about 2 hours. Small caps, same thing, sitting to consolidation and then push back up. But I think we had a really good move today for about 100 points already. So we're looking for the same thing. I'm going to remove this so there's no confusion. But we're looking for the same thing, bottom wick projections and then continuation back up here. Sounds good?
Were to pick people with
Sounds good.
extraordinary talent,
Thank you.
Yep.
depth of expertise, and a divergence of views.
Cool. I'll see you guys for the market update in the evening, and everyone on YouTube. We are going to have our simulation session on Friday, so I'll keep you guys updated for that. And it will happen here too. Alright, cool.